People need an income that's guareteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, of course, as always, ZinniaWealth.com, ZINNIA Wealth.com. And we have this show to show you that there is somebody out there who's ready to help you when it comes to planning for retirement. And it doesn't have to be a big, scary thing. It can be a great meeting. And we're going to talk about what goes into that meeting and choosing that person that's going to help you walk through retirement successfully. Charisse, how are you doing today?
Oh, I'm doing fantastic. I got a very nice tan.
All right.
Right? Kids and I went to the beach, enjoyed life a little bit, did some surfing, some boogie boarding, some fishing. It's been nice so far. Good start to our summer.
There you go. Yeah, school is out. And here we are in June, halfway through the year. It doesn't seem like that's possible. I mean, all of that emphasis on the first 100 days of Trump, and now we're like, long past that. Now we're into the second half of the year. So we got a lot to talk about. And, you know, markets continue to go back and forth. And there's a lot of angst about that. So if that's one thing that's really bugging you, give Charisse a call and let's talk through that. And, you know, Charisse, when we talk about what people are concerned about, sure, the market is one of those things. But I've got an article in front of me that says, you know, if you ask somebody getting ready for retirement, what are their first big fears? And the number one is always, I'm afraid I'm going to run out of money. And one of the reasons for that is inflation is you know, things have gone up in price. Now things have come down, but we've gone through a pretty tough time of inflation. And here's something I think kind of groundbreaking. You and I have been doing this show for 13 years, and I have never, ever said the amount of money that you need now for retirement has gone down. It's always going up.
Yes.
Today, I bring you the news that the number has gone down. It's crazy. The financial media said last year you need $1.46 million to retire. This year, they've knocked $200,000 off that, and it's $1.26. It's because of inflation. So,
who comes up with this? Where do you find this?
I know. So you're boots on the ground. You're in there with the pencil and paper and the calculators and doing all this stuff. Are people feeling like way better about planning for retirement, or is this just a nothing burger?
No, this is nonsensical stuff on Google. Probably somebody's just writing an article just to, you know,
get your attention.
Show up, get your attention. Hey, you can retire, or hey, you can't retire, or whatever they're trying to do. I didn't read the article, but no, it has not changed. And quite frankly, costs are still up. People are asking for more money.
So the concerns that you have seen over the years really haven't changed. People walk in the door and just basically say, am I going to be okay? Am I going to run out of money? And you got to figure that out.
Yes. So when we build our income plans and we do your annual reviews, you know, this past year, people have needed more money. So we've re-upped the income plan to showing a higher withdrawal strategy. We might have pulled it out of another bucket. It didn't change anything. And for a lot of these people, it'll probably go down in the next 3 to 5 years. And they'll probably say, okay, now I got too much, just depending on where inflation is. Just depending on how much they're making in the stock market or in their CDs, because as interest rates go down, so do those CDs. So they'll be looking for other types of investments that have those guarantees. But no, it's not moving the needle except for, and it has not changed our office. Even new people coming in, and our advisors, you know, have conveyed this to us that, you know, people want a little bit more money. I think we're so far out of COVID too. People are feeling more comfortable doing more. I'll be honest with you. It seemed like last year was the first year where those people were like, oh, I haven't traveled. They're starting to travel, and they're paying the price to travel, which is more expensive now than it was 2 and 3 years ago. It's absolutely ridiculous. I mean, for example, I booked a cruise with the kids in July, And it's like, to get me and 2 children on a cruise, it's expensive. And if I go back to 2018, that was the last time I've been on a cruise with the kiddos, it was like half the price.
Wow.
I know. And so the cruises are more expensive, but we're all willing to pay because we're all itching. We're ticking. We want to get back to where we were pre-COVID. So me personally, I don't know why I haven't booked the cruise and it's taken me this long, but I'm ready. And so a lot of the people who are coming in and seeing us and the other advisors are like, we're ready. We want to go travel Alaska. We want to take these cruises. We've delayed it too long. It's been nice for the last 5 years because we've done other things with our money, updating our house, et cetera, but now they're ready. But when it comes to inflation, they're still complaining. Gosh, Sharice, the grocery bill's up. The electric bill's up by like 20%. Like that stuff isn't going down.
Yeah, we are finding that there are still price increases out there in certain sectors. Maybe some things have gone down, but other things like what we want to do in retirement have gone up. Airfare and rental cars and cruises. A pool. Yeah, all that stuff.
A pool's double. I mean, I won't put a pool in my house because I will not pay the price of the new prices of those pools. And a lot of our people who are coming in, like somebody just came in recently, they're like, Sharice, I'm probably not going to get a pool like you, but the pool I want, $75,000. And 6 years ago, it was like $35,000. They're like, we're just not going to pay that doubling price. Are pool prices ever coming down, Sharice? Probably not, right? This is how it works. Now we got this inflated number and it's probably going to stick, right? I'm getting I'm giving you guys a lot of personal information today, but I'm getting a new roof. Oh my God,
Oh, I know.
Oh my goodness. Just sock it to me, new roof. That I got to get it done. And I'm worried about, hurricane season. I want to be ready. And it's like, we just got to pay the piper for this stuff. And I remember getting that quote 5 years ago exactly. It was not as high. I'm like, I should have just done it years ago.
Yeah.
Like 5 years ago. I just pushed it. We all push it. And then later on we pay more. So I'm one of those people. It happens.
Well, we've said this so many times on the show. The average retiree spends about $6,000 a month. And so we put that together for you in your plan. And then Sharice will say, you know what? In 5-10 years, that's going to be $10,000 a month. And people look at you like you got 2 heads. But that is, in fact, the truth. And we are experiencing it right now. If you're trying to do retirement on your own, is that built into your plan? How increasing income is going to be needed as you go through retirement? If not, give us a call. Let's show you how that's done. 833-368-3680. Again, 833-368-3680. Or go to our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. That's exactly what it is. It's a free meeting for us to sit down, get to know you. What have you done for retirement, and what are you going to do in retirement? Let's get that worked out. 833-368-3680. Well, in the past, you and I have talked about books that you've read. One of them that was on your nightstand, I know, for a while was Money Master the Game from Tony Robbins. And Tony Robbins is talking a lot about retirement these days. And he just said that there's one investment that you have to have in your retirement portfolio. Bonds. He said bonds are the foundation of a mind-blowing portfolio that will work in all economic climates.
Oh, really?
That's what he said.
He's not a financial advisor.
I do
love him. I have not walked on fire.
Okay.
But I do believe a lot of things he says to be true. But he's not a financial advisor. He did talk to and interview quite a few gurus out there. So I'm going to have to reread it. I don't recall him saying that, I'll be honest with you. But if it's in the book, it's in the book, because the bonds is not really the answer. And the bonds is the answer depending on where interest rates are, right? And it depends if you're in a buy and hold bond or you're in one of those bonds. Say you buy a Chevron bond, you buy it for 30 years, it's going to pay you a dividend or your coupon of 5% every year. And that bond value is going to go up and down. But by golly, they're still going to pay you that 5%. As long as you hold it for 30 years, that value will make you even, right? 30 years down the road. But most people are going to keep a measly bond that's only paying 5% when later on they could be paying 8%. And then you want to sell it and you take a huge penalty. So those are the type of bonds I'm not as big of a fan of. The Great Generation they were huge in that, but bonds were paying a yield of 7 and 8 and 9%, right? And so we're just not seeing that anymore. But when it comes to, so I wonder what kind of bonds he was talking about now.
Yeah, because when he says it's good in all economic climates, you and I have gone on and on and on about how the 60-40 portfolio doesn't always work, because there was a couple years in there where the 60 was down and the 40 was down, and it didn't work.
Right. But bonds have an inverse and opposite relationship to interest rate movements. Right. So think of the teeter-totter and the playground. And if your kids are like my children, they jump off, so it hurts your butt and you fall to the ground. But think of it, I mean, that's how painful bonds can be. So let's say you have a mutual fund or even an exchange traded fund. A lot of those are just buy and hold. Nothing's happening inside of them. Some of them are active. We have one that's very active, but most advisors don't use them. But let me kind of just explain what all that means. So let's say you have a mutual fund or an exchange traded fund bond, and you're on this teeter-totter, and you go back to 1980s, and interest rates were off the charts high, right? I mean, you go back to the 80s, interest rates were high. Even in the 90s, interest rates were high, and that's because inflation was high. So you keep interest rates to help you fight inflation. And so interest rates have come down, inflation's come down over all these years. So not only did you lock in a nice 7 or 6% coupon, but when it came down, the bond value went up. So it was a glorious time to own bonds. So what happened during COVID? Well, interest rates bottomed out, and after COVID, interest rates started to rise. We're trying to get people invested. We're just trying to clean up the economy, get people rolling again, give them a nice fixed, shorter term type of strategy. So when interest rates rise, remember it's an opposite relationship. Well, the bond values went down. So people were like, wait a minute, my bond's only yielding 3%. That's not even keeping up with inflation right now. And so you saw the bond world for a couple of years, starting in 2021, drop an average of 15 to 20%. And people are like, bonds are not the best decision factor in a portfolio for safety. So not only did equities go down, but bonds went down. So the 60-40 portfolio didn't fare as well. So that's when active management works really well, especially in retirement, because if you're living on that money and your portfolio was a buy and hold, everything was losing. But if you had an active manager managing your money that was doing day trading or at least monthly trading, well, guess what? They probably changed you from an aggregate bond, which is a long-term, more corporate type of bond, to short-term bonds, because the short-term bonds were making more money than the long-term bonds, which is not a good thing. It's a sign of potential recession. And so we don't know what's the future of bonds. And so when he wrote this book, that was a while ago, right? That was a long time ago. So times change. So maybe it was good then, and it's a good strategy then. And I'll be honest with you, we use bonds in our portfolio, but we're moving them around. We could have a 5-year treasury, a 3-year treasury, a 10-year treasury. Maybe we get back into the high yield bonds or those aggregate bonds inside the exchange traded fund. So we don't do mutual funds here. It'd be exchange traded funds. And we're bobbing and weaving, trying to fight this fight out there for our clients so that they can still get their income. But that's not usually where our clients are generating most of their income. We have other alternatives. So the bond is not the fix-all. Historically, it worked well. It's just changing. So this is why the 60-40 portfolio, myself and the Yale professors out there have written white papers on it. Might not be the best strategy. We can still have it, but let's start looking at other strategies just in case that 2000 and 2003 period comes back into our lives and now we're not faring well on the bonds.
Well, when you think about what is the purpose of a bond in a portfolio, there's a certain amount of income there. There's a certain amount of protection there. Maybe there's some other things that also have those two qualities that you can look at. Charisse can show you those. Give us a call. Give us a look on our website. It's zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. If you click on that, we'll ask you for a little information. Let's get a date on a calendar and talk about your retirement and how it's going to work. You can also bypass all that and just give us a call. 833-368-3680. All right, so Charisse, we talk about the idea of converting money from the taxable area to the non-taxed area. That would be 401ks and IRAs over to a Roth. And I know that there's some pain involved there at the beginning, but it does help you in the end. If you choose not to do this, this is what could happen to you. Somebody wrote into the Market Watch Advisor column and said, hey, I'm 90 years old and I still have $1.5 million in my IRA. So first of all, congratulations. And you're not going to outlive your money. He's done a great job. Although he says the RMDs are killing me.
Oh, yeah.
This year, I have to take $123,000 out of my account. That's what Uncle Sam says I have to do. So that means my Social Security is being taxed higher. The Medicare premiums have gone up. And he wants to know, at the age of 90, should he do a Roth conversion? Whew.
Yes. So we're talking about RMDs and your retirement accounts and your IRAs. And RMDs, this is a forced distribution. You have to take a withdrawal out of all of your retirement accounts, all of your IRAs, whether they're still the employer or you're managing yourself or they're sitting at a good old Fidelity, whatever the case is. And as your accounts grow, most people, Randy, want their accounts to grow, double if we can and triple over time. But as you get older, when you are age 73, you are forced to pull money out of this retirement account. And every year you pull money out, the percentage you have to pull out goes up. And a lot of people don't know that. We have a great chart to show people, but it starts around, 3.65, 3.85. But by the time you're in your late 80s, you're pulling out 8%. And now you have a 90-year-old sitting there where he's got $1.5 million in his retirement account, and he is forced to pull $123,000 out. So his Medicare Part B goes up. That's your IRMA. There's a penalty because you have too much money coming in because they take these RMDs as qualified money. It's your income. It's taxed at your marginal tax rates, right? And then you have Social Security provisional income formulas that make your Social Security taxes higher, most likely for most people, especially at this level. And so we have to really consider, does it make sense for a 90-year-old to roll IRA money, retirement account money, over to a Roth at this age? And I'm going to tell you, it's definitely not going to be for you. You want to start rolling these dollars out really earlier in life, like 50s, 60s, 70s is still good. I mean, I've had an 80-year-old do it. So now at this time of a 90-year-old's life, you're doing it because you're trying to leave a tax-free legacy to your beneficiaries at this point. But if he is taking $123,000 out of these retirement accounts right now, and I know he probably doesn't need to live on it, so he's just reinvesting it. He's likely reinvesting in something that's taxable, again, to him, depending where he invested that money and or possibly even to the kiddos or if there's a surviving spouse. But at 90, I'm not so sure. So we're always dealing with these taxes. So I would not recommend this gentleman to roll money from an IRA to a Roth because he has to take his $123,000 and then any money he wants to roll from his IRA to Roth, then he can do that. And that's just a bigger tax bill. And so unless you're just like, you know what, let's just knock it out, Charisse. I'm going to roll my $1.5 million all to a Roth now. I'll deal with the taxes now. So in 2 years from now, or 3 years from now, there's no more Medicare IRMA penalties. My Social Security provisional math equation is down. Maybe I'm not even paying any taxes on Social Security anymore because if he doesn't have a pension, he just has a Social Security. Hey, there are no more taxes on Social Security most likely because he's not forced to take these withdrawals. So it just depends. And, each and every one of our advisors, we're going to go through that plan. It does it make sense? Does it not? This is why we use our tax software to show you, not just tell you, we're not going to pull out a calculator, write it on a little pad for you and assume. We're doing the math and we're showing you, does it or does it not make sense? And it all depends what your wishes are, your dreams, what your goals are. If you're not wanting to leave your money for the kiddos taxable because now they have to deal with the taxes and you think your taxes are bad. Let's say you have one beneficiary that is making $100,000 and now they got to cash all these IRAs out over the next 10 years. Their $100,000 is going to 200, maybe 250,000. And so they're probably at a higher tax bracket, right? And that's if the rules don't change again. And I don't worry about the taxes now in the next 4 or 5 years. I worry about the taxes in 5 to 10 years to 15 years when baby boomers are starting to really pass away and the millennials and the next generation are inheriting these dollars. So I don't want to say a blanket statement that, yes, this makes sense to do or no, this doesn't make sense to do it. But I will say if this gentleman goes through long-term care and he needs $200,000 a year to pay for his care, he's going to have to cash it out then anyway. So I do suggest he does something, maybe take a little bit more of that RMD out and put the rest in cash maybe, if he doesn't have a long-term care plan. And it really just depends, what is he doing with this $123,000? Is he even spending it? And if he's not, he's probably saved a boatload of money. I just hope it's not taxable again to the gentleman.
Well, this is one of those stories where we can kind of say, don't let this happen to you. And this is why we talk about the idea of conversions. But on the other hand, Charisse, we got about 2 minutes left in this segment here. On the other hand, there are a lot of people that get to that point in their 70s and their 80s, and they're having to take money out of their 401ks and their IRAs for RMDs, and they look at you and say, Charisse, I don't need this money. I have enough income here, and I have Social Security, and this is just causing me a tax problem. So then when you look at somebody in their 70s who's experiencing this, then you have a few more options there where you can say, well, let's use this as a legacy plan. Let's use this as a long-term care plan because that might be in your future. So this money can benefit you as well as benefiting your heirs.
It's so true. So we get people who are 70 years old and are like, Sharice, now I'm 70. My RMDs start in 3 years. Does it even make sense to work on this IRA to Roth conversion? And I say, yes, but let's do the math. Let's pull up the tax software, the Roth conversion software. Let's really dial in what the next 30 to 40 years look like. And that's based on today's taxes, not what they could go up to, of course. And based on today's taxes, which is the lowest marginal tax favoring time period we've been in, it still says to do it. But if taxes go up, it for sure says to do it, right? It's a no-brainer. So people, stick their heads in the sand. It's like, I'm not going to worry about it. It'll be all right. But it's not going to be all right. Do you think this 90-year-old knew he was going to have to take $123,000 out of his retirement accounts? No, nobody was teaching it. Nobody was showing him the future. And I guarantee if somebody showed him when he was 70 years old what he would be paying, I'm almost sure of it, 9 out of 10 people would make the move. They'd start converting based on today's taxes.
Well, again, don't let this happen to you. This is why we have this show, is to show you, you can learn from retirees who get themselves in a fix. And we can say, let's not let that happen to us. Give Charisse a call. Let's sit down and talk about your 401k and your IRAs. Does it make sense to convert some of that money a little bit at a time, maybe over 5 or even 10 years, so that you don't run into the problem that this guy had where he's writing a check to the government for $123,000 at the age of 90. Wow. 833-368-3680 is our number, 833-368-3680, or find us online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. That is a meeting, a free meeting, where we sit down and talk through things like this. What are you bringing to the retirement table? What's in there? What have you done to save? And is it going to cause you any problems like this guy when you get into retirement? Again, zinniawealth.com. All right, so a lot of news around what's going on in Congress with the big, beautiful bill. And it made it through the House, and now the Senate is looking at it. And, Charisse, there's some things there that are going to probably affect retirees, because during the campaign trail, President Trump wanted to take taxes off Social Security. And I don't know that that's going to come through the way he wanted it to come through, but there are some things that they are kind of banging away and trying to make it a little bit better.
Well, anyone and everyone who heard the noise that, Trump was in favor of saying, okay, Social Security is no longer taxable, I had a feeling that was not going to be a true statement. People ask me all the time, that would be great. Do you think it's going to happen? Some people even said, oh, this has definitely happened. And deep down inside, I went, this is not going to happen. We're having hiccups and problems with the Social Security Trust Fund because we don't have enough people working for the people collecting. So I'm like, I don't know. Yeah. Okay, it would be great, but I'm not going to, even hold my breath on this. So now that is not a true statement. So we're not getting that deal, but something that was approved through the House was a $4,000 tax refund. And so now it's going through the Senate. So we got to see if they're going to approve that. I have a feeling they will, because it's only a savings of a couple $100s for the household, right? Yeah. So, every dollar helps, but I had a feeling that would happen. I think people were really trying to like be very hopeful, like, oh, that would be a lot of money back in our pocket. And it absolutely would. It could be $1,000, $2,000, $3,000, $4,000, $5,000 for a lot of households. That would have been fantastic. But the Social Security Trust Fund is already, having problems. And there has to be another strategy to embark in to help the fund. And there really isn't, even though we're going through Doge and we're making these cuts. We got nearly $40 trillion we have to pay off in debt. So we got to focus on that first. So maybe in the future it happens, but right now, unfortunately, everyone, Social Security is still going to be taxable to you.
Well, one of the main concerns was the Social Security Trust Fund. And if he were to eliminate taxes on Social Security, that would empty the trust fund at least 2 years earlier. And so that's one of the big, they need the time to fix this. And I was just reading this morning that retirees say it's okay if you want to raise taxes on me to keep Social Security going. I'm okay with that. So that's how important that Social Security check is.
Yeah, Social Security is super important. We want to make sure that those dollars arrive for the rest of the retirees' lives. And if we don't tax Social Security, it's going to deplete the system even sooner. So I think we got to get our debt cut down first, and then we can start focusing on Social Security a little bit more, but a little reduction in taxes would be helpful. So a couple $100 a year, people will still appreciate that. But, let's talk about the basics of Social Security while we're at it, Randy. Sure. The earliest you can collect is 62. So should you collect at age 62? Full retirement age is between 66 and 67, really 67 for most people now. And that's where you get 100% of your benefit. And when I say 100% of your benefit, full retirement age, that means if you collect at 62, that means you will not be getting 100% of your benefit, and you get a penalty by taking it early, and you've worked for 30 or 40 years to get this Social Security check. And does it make sense to take it early is one of the big questions. Hey, and if you wait to take Social Security at age 70, you do get something called delayed retirement credits. It averages 7 to 8% a year until you collect once you hit that full retirement age. So it can bring a whole lot more money to the table. And the question is, should we delay taking Social Security to age 69 or 68 or maybe even 70? And I don't want people just to assume it's the best decision, because we have to look at your health. Of if you're married, is one healthier than the other? Are you both super healthy? Or did one of you work and make a whole lot more money than the other? Maybe the other person was taking care of the kids. And is there a pension in the house? And if you pass away, does a surviving spouse get the pension if you pass away? And if not, then there's another strategy on when to take Social Security. So there's a lot of pending questions when you're trying to claim Social Security. And so without doing the math to it, I feel most people make the wrong decision. And some people out there say, hey, let's start living on our IRAs. We'll take Social Security later. Some people are like, no, let's take Social Security now, let our IRAs grow, right? Or our brokerage accounts. And so it is conflict in the universe, a financial universe, on when to do it. And nobody has a best answer, best solution. But how you figure out the best answer, the best solution for your household, is putting an income plan together. And only 1 out of 5 people get income plans or written plans. And if you're somebody who has not gotten that and you're trying to make this decision, you really got to think clearly here, be very prudent, thinking, hey, if I'm about to make this move, but I haven't seen an income plan, nobody showed it to me, I'm just making assumptions, then you need to just know that if you come to us, we'll do that for you. We do it for free, by the way. And it will give you a little bit more confidence on your decision.
Yeah, we all want to know what our paycheck is going to be in retirement, and an income plan tells you that. Social Security is part of that. When should you trigger your benefit? What does your 401k do for you as far as a paycheck is concerned? Let's get that figured out. That's really job number one, is to figure out your paycheck in retirement, and we'll do that with a meeting at Zinnia Wealth. Here's our number, 833-368-3680, 833-368-3680, or zinniawealth.com. Now, a lot of you are going to be taking a plane trip over the summer. You're going to go on vacation, and you're looking for the best airfare. Well, there's an interesting trend happening right now in the airline industry. People are starting to move away from the cheaper budget airlines like JetBlue and Spirit and Frontier. They say when you add up all the fees, the baggage, the seat fees, all that goes along with it, I'm paying about the same as if I were to fly on Delta. And I kind of like Delta better because there's better service. That's kind of an interesting concept that you would pay a little bit more to get better service. And Sharice, that is, I think, a difference that we need to point out here, that it's not just talking about investments. When you go to a retirement planner, somebody who's in the retirement space, you're going to do a lot more for people, because a broker is just going to talk about, making your money move forward, growing your money. But you are talking about preservation and Social Security and Medicare and estate planning and tax strategies. There's just so much more. And you as a client got to kind of demand it, don't you?
So the big conversation here is service and fees, right?
Yeah.
I am a Delta person. I love flying Delta. I get great service. Sometimes I get free upgrades. And I use Delta because I know that it's always the same. And I get those extras, right? I get extra cookies, those biscottis. I get extra cookies. And one time I got a whole bag of them.
It's all about the cookies.
It's all about the cookies here at Zinnia Wealth. And so you just know what you're going to get when you get on that plane, right? And I actually recently flew JetBlue and was in like the first 5 rows, and you got a couple snacks and the chairs were comfortable. And the only reason why I flew there, so sometimes you change your reasoning why you use planes and their services, because it was a one-way trip to Boston, right? Okay. Instead of having to connect through Atlanta. So I paid the same price, didn't get as good as service, but I did get to my destination faster, which was key, right? So when it comes to financial planning and airline services and fees and those types of things, there's not much difference, because you're going to pay a fee whether you go to this advisor, this advisor, or this advisor. Some advisors charge outrageous fees. Some advisors charge medium fees. And so the goal is how do we get your fees down, but still deliver on the customer service? And so what makes us different than most firms out there is that we're helping you with your Medicare. We're giving you the extra service, those conversations, right? We're giving you the income plan, the written plan every year, because life changes. We're helping you with your Medicare as you're rolling into the Medicare season. We're helping you which plan to get. We're helping you with your investments and being very strategic, not just using a 60-40 portfolio and using probably 7 different types of alternatives in a portfolio. We're also helping you with long-term care. We're helping you during that elder season of life, when we have to have these conversations with your kids, or we need to get the elder attorneys involved because maybe you didn't have a long-term care plan, and we're trying to create these specialized asset protection trusts for you, right? And then there's a whole legacy plan. But last but not least, to me, one of the most important things that we do that most firms, I would say 99% of the firms out there, that might even be high numbers, we do the tax plan. You go to your CPA, they do the accounting. We actually do the tax plan on, do we convert your IRAs to a Roth? We do the tax loss harvesting. Those are on your brokerage accounts. You can call 20 firms today and they will say, oh no, we don't do that. You could go sit with Fisher Investments and talk about Social Security and they're deer in the headlights. I'm like, no, you got to call Social Security. You can go to a Fidelity advisor who's working at Fidelity and say, hey, we need a tax plan. I'm like, oh, Fidelity won't let us do that. You're going to have to go to your tax person. So we made it very easy. So if we're going to charge the same fees as everybody else, the service is why people come to us. Service is why people stay with us, because they know these things are going to pop up, whether it's a moment in COVID or a spouse all of a sudden is losing their memory and they need to talk to us. Or what's the next step, Sharice? Whether it's Social Security, hey, do we or don't we take on Social Security? How do we actually pay 0 taxes on Social Security, right? And the Medicare. Just a lot of planning goes into what we do. And I will say our fees are on average lower than most advisors in town. So not only are our fees lower on average, our service, it's exceptional. I mean, it's like me flying Delta over JetBlue. I'm going to fly Delta all day long over JetBlue because I know the service is there. I know my water bottle is going to be sitting in that chair when I arrive. I know I'm going to get 4 bags of cookies because all I have to do is ask, right? And I know it's going to be friendly and it's going to be a good flight. And I just know the rules, right? And so I stay consistent with them, because it works.
Well, we would love to be able to show you what those services are. And to do that, you can give us a call and we'll sit down and talk about what we can do for you to try to build the retirement that you want. You've got it in your head what you want to do in retirement. Let's put the money with the stuff, the activities, and let's show you what we can do along the way. This is not just a one-time transaction that you're going to sit down with Sharice one time and it's we set you on a boat and off you go. No, that's not it. We're going to help you go through retirement and walk with you every step of the way. Give us a call, 833-368-3680. 833-368-3680 or online at zinniawealth.com, ZINNIA wealth.com. And the gold box there, it says complimentary retirement consultation. If you click on that, we'll ask you a few questions and our team will reach out to you and find out what's concerning you about retirement and how can we help. Again, 833-368-3680. All right, so if you ask a person getting ready for retirement, what's making you nervous? Why are you all shook up about going into retirement? Number one, they don't want to run out of money. We hear that all the time. I'm scared I'm going to run out of money. And then the other one is inflation. And we've talked about both already today. Well, the people at J.P. Morgan went out and asked 5 million retirees. They got a lot of clients, okay? And they found that a lot of these fears that we hear in the media are overblown. So there are people out there that aren't afraid of running out of money. They have their plan, they're set, they have their income, and they're doing just fine. And they don't have $5 million, okay? Now, I want to ask you this. So people come into your office, and I know you tell me a lot of times they're really nervous. They don't know what's going to come out of these numbers. Are you mostly telling people, hey, you can retire. You got the green light. It's going to be fine. Or is the meeting usually, you know what, we've got some work to do here. You might have to work another year. We got to do this and that. What's more common?
So the number one fear in retirement, and before you even retire, is can I retire and will I run out of money? People fear that because they've seen friends run out of money. They've seen family members run out of money. Maybe that was them. They're already been retired and they don't have that $1 million that they had back in 2005, right? And they're taking high withdrawals or the market went down. It just didn't work out in their favor. So yeah, I feel most people who come into our office that are new to us, visiting us for the first time, they fear running out of money. I mean, I have people that have $5 million, Randy, and I'm meeting for the first time. They're collecting Social Security, and they're like, Sharice, I'm afraid to pull too much money out of this account. And I already know they're going to be fine. I just have to show it to them through an income plan and through their written plan. And the reason why people fear running out of money is because they don't see the plan. They don't actually see what their money's doing, how much they're pulling out. Is their income going up every year to keep up with inflation? And they're just doing it all on hope. Or they went into a big brokerage firm or a big bank and they got 10 pages of diagrams and it looks pretty and all they see is rate of returns. But they know in reality, I'm like, sounds good, smells good, looks good. But why do people fear running out of money? So this can't be the 100% direction because, or I wouldn't be nervous right now. And so what makes people not as nervous is that, yes, you can show them those fancy diagrams about your investment future, but you've got to show them the income plan that shows every year, this is where we're pulling our money from. This is how much, and especially during the go-go years. So where people fail most when it comes to this is that during their go-go years, most people spend less because they are fearing the potential of running out of money because that's not their wheelhouse. They don't know financial planning. They don't know how to invest their money. They just, hey, we're going to take it to Fisher. We're going to take it to JP Morgan. We're going to take it to Wells Fargo, or we're going to manage it on our own. We'll just put it into these indexes and we'll be fine. And at the end of the day, they're not fine because then sometimes they're taking too much money out, but most people don't take enough money out because they see the ups and downs of their portfolios. They don't know how to control their emotions. And sometimes they're making bad moves when they're supposed to hold. Or there's nothing happening in their portfolios when something does need to happen because they don't know how to do it, or their financial advisor is a buy and hold advisor. So that's why it's important to go to a retirement planner that understands what you're going through, these big emotions, because not all your money should be in the market. It should be very diversified. You should have 7 different types of portfolios in your portfolio, not just a 60-40 portfolio, not just an annuity, not just cash. You need to have a mixed bag because that will ultimately help you stay probably consistent in your emotions, not sell when the market goes down, and take advantage of the go-go years, your first 10 years in retirement while you're the healthiest. And I will say 9 out of 10 people, if I have not, or our team has not sat down with you, and now you're 10 years into retirement, you're coming into us saying, hey, gosh, I really, missed this. I didn't take as much money out of my retirement accounts because I feared running out. And now I'm 70, 75. And now my health isn't as good. And now I want to pull more money out and travel, but I can't travel like I used to. And because they watch these accounts grow and they're like, oh, I got plenty of money. I've got a big enough legacy. And woulda, coulda, shoulda, right? So if you fear running out of money, more of a reason to come in and sit down with us so we can analyze your income plan or put one together for you so that you can enjoy those go-go years and not enjoy them too late when things happen and, maybe you can't even do the walking tour in Alaska, right? So creating that plan. And yes, most people do come into our office for the first time nervous because nobody's shown them, right? You could be a police officer, you could be a teacher, even attorneys come in and doctors come in and see us. They're like, Charisse, I don't know how to do this. Help us, because they're just fantastic in the field they're in, but they don't have a clue about the rest. So, and this is why, we provide the services that we provide. This is why we show you the income plans and the tax plans, because when you see it all buttoned up together, and you see the consistency of it, especially as years go on, you're going to like, okay, we're living life, we're maintaining, and hey, I need 30,000 because I need dentures, or I need my teeth done. Charisse, do we have this money? Yes, let's put it in the plan now and see how we bob and weave and what accounts we're going to pull it from. So just knowing that you have that service, just knowing that not running out of money in the future is going to be the key to enjoying probably retirement over the next 30 to 40 years.
It all comes down to doing the phrase that we say every single show. Let's do the math on your retirement. That's where you're going to know. Did you do a great job? Is there enough money there? Are you going to have a great retirement? Is there more work to do? Let's find out now. Give us a call. It's 833-368-3680. 833-368-3680. Or our website is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that and you'll be on your way. All right, so one of the things, Charisse, you're all into all the time. You're talking about how you're improving yourself. You're improving yourself as a CEO of a company. You're improving yourself as how to deal with employees and how to deal with customers, always taking continuing education. We're all told, work smarter, not harder. I hear it all the time. All right, simplify your life, organize your life. Okay, we all know that. When we get into retirement, when we build a retirement plan, this is a part of what we will do for you at Zinnia Wealth. I envision, Charisse, people coming in for their first meeting and they've got a box and it's got all these papers in it.
Stop saying that, because people are bringing boxes in on their first appointment and suitcases of stuff, and I need it before. Keep going.
But it's full of insurance papers and banks accounts and investment, portfolio stuff and all this, and it's not needed. And we have to sit down and we want to simplify your financial life. At the same time, Charisse, we want to build a plan, but we also want to make it easy to follow so you don't get, swimming in documents. That's a part of what you do, isn't it?
Yes. So when you're getting ready to retire, and or maybe you're already in retirement, for some reason we feel like we have to save everything, and you'll have stuff from 20 to 30 years, right?
Yeah.
So what we need when you come in is, just your most recent statements, even if they're a year old. Social Security, anything about Medicare, any long-term care policies, life insurance, all those things. So that's an important part. But you know what ends up happening? People bring a box of stuff in, and they have 4 life insurance policies. Sometimes they don't have a long-term care plan, and they have all these different investments in different custodians. And so what we find is people have a lot of overlap. And so when you get to the season of life where you want things simplified and you want to start getting rid of some of these policies and consolidating things. So I say consolidation is key as we're aging into retirement, to make life easier, to make, if you were to pass away, somebody to come in and figure out what's what, right? So sometimes you have a trust, sometimes you just have a lockbox for all your stuff, right? So we want to make life simpler. We want your investment strategy to be a little bit simple. And right now, most investment strategies, you work with a broker or a big bank, and you'll bring your statements in, and we'll do a Morningstar and a portfolio x-ray and a quantitative analysis. And what we end up seeing is you could have 100 different stocks in your portfolio. Why does anybody have 100 stocks in your portfolio? You should have 20. Maybe 30. But some of these big banks and brokerages feel that you should have Home Depot, Lowe's, okay, maybe, but then other like companies, Tractor Supply, like why do we have all 5 of them in there? Pick 2, pick 1, right? Let's consolidate. And you think that because you have 100 stocks, you're like, oh, this advisor's good. They're great. Look at all these stocks. And then you're like, oh, my advisor trades, every quarter, every 6 months, and they're not trading most of the time. It's a rebalance. We are forced by law to rebalance your portfolio. So you have a 60-40 portfolio, and it kind of gets out of balance, and now it's a 65-35. They, by law, have to rebalance you to 60-40. So they're just selling some of your equities, putting you more back into bonds. That is not day trading. That is not an active strategy. That's called a rebalancing strategy. I hear this all the time, and I look at their portfolio. I'm like, no, this is not an active trader. This is not moves are making because it's for the best interest of you. It's just what we have to do, right? So getting control of your investment strategy and getting rid of the junk inside that portfolio, because we don't need it all, right? And no wonder why people are confused about their investments, because, even look at Dave Ramsey, Susie Orman, those guys, those are the big gurus out there. They say no more than 5% in one stock, right? Mm-hmm. So that's a simple thing to follow, right? I don't believe in everything that they say, but sometimes people come in, Randy, and they've got 20% of their portfolio in Home Depot, or they'll come in and they'll have Home Depot, Lowe's, Tractor Supply, and somebody else. That is 20% in the same category. No, stop it.
We are all kind of creatures of habit. It's not uncommon for people to come in with 3 401ks, and let's look at your Vanguard. You're in the S&P 500. Okay, let's look at your Fidelity. Oh, look, you're in the S&P 500. Let's look at your John Hancock. Oh, look, you're in the S&P 500. Everything is doing the same thing. Yeah. It's not necessary. Mm-hmm. And this is one of the things that we're going to help you with as you sit down. It's, again, as we talked about, this is part of the service at Zinnia Wealth. Let's help you not only with your investments and your taxes and your estate planning and the legal documents and the Social Security, but let's help you simplify your financial life. Give us a call. Let's start the process. 833-368-3680, 833-368-3680, or our website, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. Click on that, and you'll be on your way. Sharice, that is all the time we have on the show for today. I'll give you the last word.
Thank you for tuning in today. As usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.